Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Seattle Investors Club podcast, where we talk about the nuts and bolts of real estate investing. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I am good in the hood.
Yeah. What are you up to?
Me? Oh, man. What do you mean, what am I up to? I'm out back over here in Seattle slaving away with we have some flips on the market. We have new construction on the market from one of our wholesale deals. We've got a bunch of listings coming on. So yeah, I'm over here slaving away. What are you doing, Joe?
Well, I'm hanging out about, 400 meters or so from Disneyland. Thought we'd stop in and see Mickey while we're cruising through the LA area.
Nice. Did you go in Mickey's house?
We didn't, but we were waiting in line to get a picture with Mickey yesterday, and then a cast member came up to us and said that Mickey had to go on a date with Minnie, so we didn't get a picture.
Oh, nice.
What's up with that?
Yeah. So tell us more. You are down, and give us a little quick update on the Fantastic Life. Is that what we're calling it? The Fantastic Life?
That's what we're calling it. The Fantastic Life. Yeah. So we're down in LA to start off our trip for a year or so in the van. And we had to get one last thing done. We wanted custom legal seat belts in the back. We thought that was important. And unfortunately, we had to come down all the way to LA to do it. But it's right next to Disneyland. So I'm not complaining.
Right on. I wouldn't be complaining. So you guys are sleeping in the Disneyland parking lot in your van or what?
I wish. The van would be nice in the parking lot. But no, the van's getting the seatbelts drilled into the side of the body so they will be legal, so people will not fly out of the van if we got in an accident, which we won't do anyway, but figured it'd be a good idea. Yeah.
So what's up? So you're posting all this stuff, and for those of you out there that are travel enthusiast or like this, the whole awesome van experience. It's not just a van. We're calling it a van. Tell us what it really is.
It's basically a motorhome a van that's been built into a motorhome, and we actually pretty much have a full gym with us. So if you guys want to see the craziness, you can go to The Fantastic Life pretty much anywhere on, Facebook, Instagram.
You know what would be awesome is if you were able to get some photos or videos of you and Mickey Mouse working out of the van. That'd be hilarious. But the van's not there, I guess, because it's
not. I could tweet at Mickey though and see what he says.
There you go. But. Well, speaking of awesome people, we have an awesome person on the podcast with us today.
Yeah.
Super impressive. Whoop whoop. Shout out. Tamar Mar. Joe, what do you think?
Yeah, guys. We are excited to have Tamar Mar on the podcast today. Tamar, how are you doing?
I'm so good. And I have to say, I'm trying not to laugh during all of your bantering over here. I was like, should I laugh? Should I not laugh? But I giggle an awful lot. So y'all need to be prepared that this will be kind of a giggle session. And I'm super pumped to be here with you guys.
I think giggling's okay. What do you think, Julie?
Giggling works for me. Giggling or whatever else. There's all kinds of things that go on here. Buddy's here too. So
yeah, Buddy the dog.
Buddy's our sidekick. So let's kick it off.
Yeah.
And find out more about Tamar Mar. We like to say your name.
I like to say my name too. I've been married for next month. Well, July 7th will be 17 years that I've been married. I can't even believe it. And I still laugh every day about my name. It just cracks me up. It's like, how could I not take his last name? It's just the best.
I know. I can't stop myself from, even though I know it's like a funny thing, like with the Tamar Mar. When I see you, it's like I can't stop myself from saying Tamar Mar.
I know. Yeah. Everybody says it. It's the thing to do. So I'm glad you do.
Yeah.
Yep.
Awesome. Tamar Mar.
There we go.
I'm going to start saying it all the time now too. So.
Thank you.
So Tamar, we'd love to hear more about your background, or make sure that everyone listening knows more about you. And I'd like to know more in fact, as well. So share with us, where are you from? How'd you get involved in real estate? All that fun stuff.
Totally. I'm a born and raised PNW, Pacific Northwest gal. I grew up in a super small town called Duvall, Washington.
Oh, yeah. I'm from Woodinville.
Yeah. And it is Duval, accent on the do, not Duval. I'll just have you all know because everybody says and people who were born and raised in them back when it was actually country, they all call it Duval. So, born and raised there. And I've only ever not lived in Washington for 5 years. 4 of those were in Minnesota when I was out there for a career change. And then I lived in Kenya for a while for a change program. And that was rad. And my husband proposed to me when I was in Kenya. He flew out there to visit me and he proposed to me there. So that was kind of cool. But so I don't know, right now, if I just look at snapshot of like the last 20 years, a big portion of that was spent in the startup and small business space. I have a super, super passion for startup culture and spent a lot of time with that. And in the 5 years before I left my job a year and a half ago to pursue other things on my own full time, I was an operations executive for a couple of different startup companies, one on Wall Street and one locally. And so I got to this point where I said, I've been helping other small businesses grow for so long, and I know I'm really good at it. I can start my own thing. So I said, it's time to be the CEO of my own dreams, not the CEO of somebody else's dreams. And at that point, I had no idea what I was going to do. But I spent about 3 months to let my mind be really creative and just pursue some different options. And I decided I was going to be a full-time business investor and real estate investor. And we have been investing in real estate for over 15 years. In fact, I bought my first house when I was 19, believe it or not. Super crazy.
Wow.
But I decided to ramp it up to a whole new level. So like before then, we had been buying houses on auction for the previous 4 years and turning them into rentals. And we had a couple of rentals before then. So last year I started a syndication business, and that has been going smashingly well. And I also bought a fitness company a little over a year ago as well.
No wonder Joe is attracted automatically to having Tamar Mar on the podcast.
Heck yeah. Just for a split second, I can't help myself. What is the fitness business?
Yeah. The fitness business is called The Fitness Shop, and it's a high-end specialty fitness equipment retailer in Bellevue, Washington. And it's been in existence for like 40 years throughout the Pacific Northwest. And the founder and old owner, he was ready to move on because he was in his 70s. And my cousin had lived there, kind of lived there, works there for about 13 years. And the previous owner presented him with the opportunity to either buy it or it was going to close down. And at that point, my cousin wasn't, he didn't want to lose his job. It was kind of his lifeline. He really loved that business. He has a passion for fitness. And so he came to me and my husband because we're the most business savvy people that he has in his life. And he said, Tamar and Bruce, I'd really love it if you guys would partner with me on it. So we went in with him as partnerships. And I'm not in the day-to-day operations of that business. I'm more on a high-level strategy and finance type of thing. So I don't spend a ton of time on it, but I meet with him every week and pump him up, and he does all the operations stuff.
So cool. So
yeah. Is that a brick and mortar store then, or?
Yeah, it's a brick and mortar. So we have a retail showroom, and then we also have a commercial sales division. So we have a rep that goes out and we sell to, hospitality, apartment complexes, corporate gyms, fire stations, that sort of thing, universities as well. So we have a footprint all over the fitness industry in the Northwest.
I'll say what you said earlier, that's how I know how great of friends we're going to be, because you used the word rad. That's my word.
It's my number one word. Besides
that is my
dude.
Number one word.
Yeah, dude and rad. They're just.
Oh my God, dude and rad are my words. And you want to know what's crazy on top of this, Joe? Mm-hmm. Dude. Hey, dude, you want to know what's crazy and rad on top of this? Tamar has twins. Just like me.
I know. We both have twins, and they're almost the same age. I think they're only like 5 months apart or something.
God, and my twin's last name is Mar. No, I'm just kidding.
No, it isn't. dude, no, it isn't.
Yeah, just teasing. Yeah, that is, there's a lot of, just naturally here, sorry guys, we're just having a chat among friends here. Thanks for all you guys just listening along. But a lot of synergies in life and passions between Tamar Mar and Julie and Joe of Seattle Investors Club. So this is just pure fun for us today. I'm going to get us back on track because we've already goofed off and got off the rails here as we normally do. But along those lines, maybe we can take a few more minutes off the rails because checking out, if you guys go to, is it called the Marotta Group? Is that how you pronounce it correctly?
Marotta Group.
Marotta Group.
Yeah.
Which is Tamar's company. And you look at her website, you'll see that she is quite an adrenaline junkie even possibly a toothbrush expert. What's that all about?
What?
Well, okay. So I worked for a startup company called Optiva. I started there a month after I turned 18, and the company had been in existence for only a little bit at that time. But it was the makers of Sonicare toothbrush, which was the first sonic toothbrush. And we were there to explode that company to the fastest growing privately held company in America. And I ended up being a sales rep for them inside and then outside. And I traveled all around the country to launch products, give presentations in front of hundreds of people sometimes at trade shows. And then I was even selected to go to Japan to be the host for a Japanese infomercial for Sonicare toothbrush.
Wow.
It's the truth.
That's hilarious.
Yeah.
I know what I'm going to get you for Christmas. I'm
What?
going to get you like a whole toothbrush setup. I don't know. Not that you already have all that, but
it was so long ago. But our friends, it was the best time of our life, and it's what hooked us on. I actually met my husband there, and it's what hooked us all on startups because still to this day, in fact, we were all at a memorial service the other day, and the person that passed away was somebody from that company. And we all got together and we're like, that was the best time of our lives working for that company. And it was all because of a toothbrush.
Oh, wow. Well, you know what? My daughter, Katie Clark, has made a toothbrush short movie.
Oh.
And outside of this, if anybody wants to see it, it is badass. It's rad. Shoot us a message, make a comment down below, or maybe Joe, I don't know if you can link it to this podcast. Mm-hmm. Katie's toothbrush movie. Speaking of toothbrushes. Yeah, we're not talking about real estate today, guys. Sorry.
All about the toothbrush. I'm checking it out for sure.
That's hilarious. Yeah, she made a toothbrush movie, and it's totally awesome. I think you're going to be surprised. So we'll send it to you, and we'll hook it to this podcast. All right, now I'm really going to get us back on track. So, you have a podcast as well.
I do.
Yeah, tell us about that, and tell us about your investing for life philosophy.
Sure. Yeah, the podcast kind of sprung out of a bunch of different things, but my investing for life I couldn't say that very well. Investing for life philosophy first came about, and I think it's a lot of just my personal philosophies of taking care of people around you and making sure that we live the most abundant life possible. So part of it is that when I invest in communities, and I invest in apartment buildings primarily, I take a portion of my proceeds and give them back to whatever community that I'm investing in. And it just kind of depends on what I want that to be at that time. It could be to improve the trails in the area because I'm a huge nature freak, or it could be something that's related to a community playground or something. I don't know. So that's part of it. But I think also investing in our own lives on a daily basis, spending time with ourselves, getting to know ourselves, make sure that we're performing as high as possible, and investing in the lives of those people around us. And that can be as simple as just listening to somebody talk when they need somebody to listen to them, or spending time with somebody and doing something you love together. Awesome. And my podcast, it started in December of last year, 2017. I forgot what year it was. And it just talks about that. So the whole intentional lifestyle design piece coupled with entrepreneurship and investing, and how you can design your own life by doing those sort of things, finding the right business that fits your lifestyle. And I've been able to curate that sort of life for myself. And I like to help other people do the same thing.
Awesome. So cool. you guys should listen to Investing for Life, just because, a lot of people get into the real estate biz because they're looking for freedom, financial freedom. And real estate is one way and a means to do that. If you do it consistently, correct, and with good intentions. But maybe you might, what's the whole point? Is the point to be a real estate investor, or is the goal financial freedom? Maybe you guys should check into, or not maybe, you should check into Tamar's podcast, get some tips. Maybe there's some things that you can free yourself of and get to that freedom faster, rather than it just always being all about real estate, right?
Yeah.
No doubt on that.
I'm subscribing right now.
Right on.
Ooh, hello.
I'm not talented enough to multitask at the same time while we're doing
Neither am I.
I'll do it
That
afterwards.
was so good. It's because Joe wasn't talking at the time.
It's because he's sitting, he just went to Disneyland. He's all hopped up on the goodness right there.
Mickey goodness.
Well, let's get back. So today, I want to talk more about syndication. I mean, I think that is something that people have interest in. Right now, we're in May of 2018, and buy and hold, cash flow, passive investing is all the rage. People are starting to tire out a little bit on the fix and flip. A little bit. It's hard to find contractors. It's, even if you can get the projects, trying to have contractors lined up in time to get it done quickly and efficiently is getting tougher and tougher. I think, one of the things that I'm interested in educating on going forward here in a big way is really kind of flipping things backwards. Everybody's taught to get into wholesaling and flipping and rehabbing, and, then later on get into passive investing. I think they should be jumping into that from the start and understanding and starting with learning all about debt and how different debt structures, or what kind of goals they need to reach for themselves in order to qualify for loans to buy passive income from the start, rather than wholesaling those off and all that kind of stuff. Super interested, I think people are going to be to hear about syndication, because, everybody is interested in, going for it, at least in the circles that we run in. And I think they'll be interested to hear about how that works, how to set it up, and, some details you can share with us today. So I'll just start by saying, in real estate investing, having the end in mind is important from the start. So when you plan and underwrite your syndication deals, are you thinking about, like a 5-year hold? I mean, you have to have the end in mind before you even get started. So what does that look like for you on the syndications?
Yeah. I never underwrite for 5 years. And that's the biggest reason why, is because we are looming at some sort of top of a cycle right now. And I think the very worst thing that you can do is plan to sell something when we're at this, at a stage where we don't know when it's going to start coming back down. Additionally, that means that when you're investing in apartments, if you have a 5-year balloon on your note, and you're stuck where you either have to sell it or refinance, and your interest rates go up so much and your cap rates go up so much that you cannot rescue yourself from that sort of situation. Right. So I underwrite everything for a 10-year hold. It doesn't mean that I'm going to hold it for 10 years, but I consider my role to be kind of an opportunist role. I want to see what opportunities present themselves over the course of that 10-year period. And then I can present those opportunities to my investors if they do come up, meaning if I want to refinance the property and cash out some of our equity, if there's somebody that comes and gives us an offer we can't refuse and we decided to sell the property and cash in on our equity. But the 10-year is mostly because, typically speaking, a real estate cycle lasts around a decade. So it could be 8 to 12 years, and it depends on where we are in the country. But I like to just look out on that horizon and make sure we can survive and thrive for that period of time.
Sounds good. Sounds perfect. So, when people are interested in, everybody's looking to get in the buy and hold these days, and they can buy their single family buy and holds. They may or may not be at the place where they can take down an apartment building, but they might be at a place where they can get involved in a syndication as an investor, what's the difference between accredited versus non-accredited investor? What does that mean? And is one required, or is it optional for syndicators? How does that work?
Yeah. So first of all, we'll go to accredited versus non-accredited investors. So the SEC or whatever governing bodies like to define accredited investors as individuals making $250,000 annually, or married couples making $350,000 filing jointly, or a net worth of $1 million or more, not including the equity in their primary residence. So they think that if they have that much income or money, then they're not going to make stupid decisions, which I don't know if that is really true or not, but and then there's non-accredited investors, or you can call sophisticated investors, are another step. And there is no real monetary definition of what a sophisticated investor is, but it could include anything like, I've invested a bunch in the stock market, or in gold or Bitcoin, and I kind of understand the risk reward scenario. And so as a syndicator or a sponsor of a deal, I need to make a decision. Am I going to allow only accredited investors in, or accredited and sophisticated investors in? So usually you wouldn't allow in somebody like, let's say, Uncle Pete, who's 72 and only has about $25,000 to his name, and he's going to invest all $25,000 and he doesn't have a job. That would not be a smart idea to allow somebody like that in, because I have a fiduciary responsibility to make sure that all these funds are okay. And what if he loses everything? That would not be good. So there are different types of rules from governing bodies, namely the Securities and Exchange Commission, that tell you what you can do with accredited versus unaccredited and these securities offerings. And I won't go into all the details, but there's like Rule 504 and 506B and 506C, and it's probably really boring to you, except to me, it's exciting because this is my business. But you have rules on if you're allowed to advertise your offering, which is usually a big no-no, who you're able to reach out to, and the number of investors that you're allowed to have. So most offerings that allow sophisticated investors, for instance, you can only have up to 35 sophisticated investors in any one offering.
Right. Can you have a mix of accredited and sophisticated investors on a deal, or does it need to be one or the other?
You can. If you do a 506B, you can have a mix of the two with a maximum of 35 sophisticated. If you have a 506C offering, it's only accredited investors.
Okay. 506C is accredited. And so have they raised that? Did it used to be a little bit lower, like 200 and 300 instead of 250 to 350 on the accredited?
I don't know, but I imagine at some point they did, just because of inflation and the power of the dollar.
Right. Awesome. So what do you do your deals as? What have you been doing? Which are you going with, a mix, or are you going with one or the other?
I'm going with a mix. And I think the biggest reason why is especially if you're starting to work on these types of projects. I live in a nice area and there's a bunch of high income earners around me. But when, up to the point where I started my syndication business, we were only using our own money. So we were using a strategy where we had a giant line of credit and we were using that to purchase houses and then pay ourselves back. So I was only started using other people's money, OPM, in the last year and a half. And so I hadn't built up my investor base. And that's what I've been doing over the last year and a half. So it doesn't mean that I necessarily have access to 100 accredited investors, but that slowly builds up over time. Additionally, I like to provide opportunities to friends and family who are really excited about real estate investing, but maybe not have that status attached to them.
Right. So who decides if, so you're doing a mix, and who decides, do you get checked? Is there like a paperwork you have to keep all the investors accreditation or details about their sophistication in a file, or do you have to send something to the SEC? How does that work? Is it your choice to let them in or not? Or are you monitored on that with a syndication?
Well, some of this stuff is very loose and there's not a lot of definition, and it even depends on the attorneys that you speak with, because they all have a little bit different. It's kind of like somebody saying, what does the Bible mean? A lot of them have different interpretations of the rules surrounding this. But the most important thing is to keep track of, are these people that I know really well? And do I know their background? Meaning, like, do I know if they are financially viable? The paperwork that we have to fill out usually comes with the private placement memorandum that you put together and the subscription agreement. There is at least in what I've done so far, a checklist in there that asks a whole bunch of questions to define if they are an accredited or a sophisticated investor, and they disclose that information there. So I do keep that on file. In the type of offering that I do right now for my deals, I don't have to prove any accreditation status with further inquiries into their financial status, meaning like any sort of audits. But there are certain types of offerings out there where the onus is on the sponsor to find out, dig in a little bit more, I guess you would say.
So as long, for what you're doing right now, as long as they've filled out the paperwork, and you know them and you have done your personal due diligence and are comfortable, because we all know you want to be on the up and up anyways, and you're probably going to err on the side of caution anyways, that should do it for you, right? I mean,
to my understanding, yes. And that's what I feel comfortable with.
Right. This isn't legal advice, everybody. None of us are lawyers. None of us play lawyers on TV.
Not a lawyer.
None of us play lawyers on TV at this time.
No.
Although we just did, I was telling, I don't know if I told you, Tamar, we had a breakfast the other morning. I told you that the casting agency from the $1 Million Agent or $1 Million Listing TV show is calling. They want to do a flip show in Seattle, and they've called us. It's pretty, so who knows? Maybe, if anybody's going to be on TV, it's probably going to be Joe. That's what I figure. But it's going to be about the van.
The Fantastic Life.
Yeah.
Well, if anybody wants to dig in, we have already been on TV for the van.
Wow.
What
was that?
Search for CrossFit campers under the show Car Matchmaker, and you might find something interesting.
Wow.
Okay.
Awesome. Oh my gosh. Well, I feel like I don't even want to talk about real estate, but I am personally, selfishly so interested in syndication. I want to know more.
Me too.
What's the minimum investment that you require? And is there a minimum in general that people have to stick to, or is it all up to you? I mean, obviously it's limited if you're, up to the 35 investors on the sophisticated side. So if you have 10 sophisticated investors, can you have 30 accredited investors? If you're talking about a bigger project that needs that much money, you can do that, right? It's just
Yep. I can do unlimited accredited investors. Minimums really depend on the sponsor. The really big dogs that are out there, a lot of them that are in Texas or other areas in the South, they do usually minimums of 100,000 or more, depending on how well established they are. Some people go as low as 25,000. You have to take into consideration that there is a lot of administrative tasks that accompany have the amount of investors that you have. Not so much ongoing down the way, but at the beginning, there's a lot of it that goes into there. And then there's tax prep and having to provide K-1s and all of the investor relations piece. So for me personally, right now, I'm doing $50K for my minimum investments. And then there's a maximum to consider as well, which a lot of people don't talk about. But the maximum investment is, unless somebody wants to sign on the loan, is no more than 19.999%. So if you do 20% or more of the down payment, you are required to sign on the loan. And I always disclose that to investors, because I do have some that provide, $150,000, $200,000 or would like to. And I say, okay, well, for this deal, 140 is the maximum, or 175. So they'll push that limit as far as they can so they can get in on the deal. And
I think that is a very important, I want to go beep, beep, honk, honk, and highlight what you just said, is that in order to not be a guarantor on the loan, you have to stay under 20% ownership of the property. Is that the correct way to say that?
I would just change that a tiny bit, Julie. So in order to not sign on the loan, but the type of the loan, recourse or non-recourse, is going to, of course, determine if you're a guarantor, because a non-recourse loan means they can't come after your personal property if something goes awry with the asset. But usually for any loan balances under $1 million, you're not going to be able to achieve that sort of loan. So you'd have all full recourse loans. And in that case, if somebody is signing on the loan, they can go after your personal assets and the asset that you're investing in.
So even if you're investing through using an LLC, is that a layer of protection or not?
Well, yes and no.
Are we talking we're talking legal stuff here.
Yeah, we're talking legal stuff here, and that's too much for me to dig into probably. I mean, I understand. I worked with a team of lawyers for 4 years in New York, so I understand a lot of it. But
well, let's just leave it at that. Let's say that, guys, if you're interested in becoming a passive investor through a syndication, just know that there is a threshold of this 19.99% that you need to decide whether you want to play above or below that threshold. How about we say it like that?
Perfect. Yep.
Yeah. And it has to do with your risk and your liability related to the debt on the property, right?
Exactly. Yep.
Right on. Yeah, that's actually, so I came up in the ranks. My 16 years of my first start of when I started getting into real estate was working for a big time local private real estate investment company. And I was involved in essentially syndications, even though it was all private with our company and not outside investors. But yeah, I'm well aware of that 20% rule there because we were investing in 200 unit properties and things like that, which are big crazy beasts on their own. But
yeah, they are.
So, do you use a property management company on your property? Do you self-manage? What do you do on that?
I 100% use a property manager. That's one of the great things about moving from single family to multifamily. And I'm not talking about 0 to 4 units or even 6 units. I'm talking larger apartment complexes. You have the scale that you can work with. So it's a lot easier to cover the costs of a property manager. So my role is to find the right property manager through a lot of due diligence. And then I manage the manager, especially if I'm buying underperforming assets or assets that we're going to renovate. So I check in often with them and make sure that our plan is being accomplished and, dig into the reporting and all that kind of stuff.
Does the property management company, I know they get their, monthly property management fee, which is based off what? Is based off net collected revenue or what is it?
Gross collected revenue. Yeah.
Gross collected revenue.
And that includes, when you have an apartment complex, it includes all revenue. So it's not just your rents. It's if you have RUBS on there, which is ratio utility bill back system. So essentially like utility charges or laundry income or late fees or violations, it's on all that gross revenue.
So when I made the mistake of using the word net, I meant it is not, there's gross rents, which are if 100% of the units were rented, and what would be that gross rent number. But there's then, I'll call it, I don't know what the net revenue, which is your rents less your vacancy loss plus all your other income. Is that what it's calculated off of?
Yeah, I think it depends on the property management company. And those are really good things to look through the contract with a fine-tooth comb.
It's also, guys, an opportunity for a little value add if there's an existing property management company on the deal that you're buying, and you can change property management companies and change the way the management fee is calculated, right?
Mm-hmm. Yeah.
That might be a little value add opportunity there. Let's see, what else do we got here? So so you would be considered the sponsor. Well, let me back up for one more question on the property management stuff.
Yeah.
Is the property manager, are they just fee-based, or do they get a piece of the deal or a success fee or any of that stuff?
Ooh, that's a great question. I have not had any so far have a piece of the deal, although sometimes investors do that because property management companies are a great source of deals. If you think about it, if you're investing in, let's say, a second tier or a third tier community instead of, King County metro area, which is insane, they're going to know a lot of the properties that are either that they're managing or that they want to manage. So they might be the very first people to hear that the owner is getting ready to sell that. So that's why I network with property managers as well, as a side note there. But if they bring something to you, they might get a cut of it, or you can negotiate that with them so that, if they're owners, if the property managers are owners of their company, then they could take a cut of it and provide you with a discount for their services.
Or bonus them upon stabilization and refinance of after the value add, stuff like that. Because I think getting people involved, and so you can just crank through. I guess it depends on if you're doing multiple deals in one market or if you're spreading it all around. It probably makes a difference. But just something to think about, guys, is how you can leverage working with your property manager on your syndication deals, or even on your regular old single family investing buy and holds or little smaller properties, right? How can you leverage the relationship of your property management company to benefit so everybody wins, because those guys, there's not a lot of, I don't think there's big money-making business in property management. I commend and applaud those who have chosen as their career to be in the property management game.
It's a tough business.
Thankless grind.
Yeah.
It is a thankless grind. And so, if you can find a good one and cut them in somehow with success fees or things like that, I think that is not a bad idea at all.
Just something else worth mentioning there too is that two things. Number one, if you're buying any sort of value add property and your property manager is managing the renovations, it's very likely if the dollar threshold is over a certain amount that they'll take a cut of. They'll charge you maybe like
a construction management fee.
Yeah. Yep. And then the other thing is that everything in this life is negotiable. So if you come across a contract, and again, look through those very, very closely, or have your attorney look through them, because if you're getting in a bed, so to speak, with a property management company, sometimes they can hook you in for 2 years and no optional clauses to get out, or they'll charge you a certain amount of money to get out. But make sure that you're negotiating and even their fees, the terms, everything. It's just like negotiating a real estate deal. There's lots of ways to be creative there.
That's right. When you guys are doing your due diligence on buying apartment buildings, maybe it's different on smaller properties, but once you start working your way up to buying, bigger properties, there could be contracts in place that could be just month to month or expiring in the first year. That could be anything from a laundry contract with a laundry, like if the laundry machines are rented in the laundry rooms.
Yep.
There's all kinds of value add stuff related to that. There could be just simply like landscaping contracts and things like that in place that can be renegotiated to be cheaper or somehow, benefit the property and the bottom line better. All the things you can do without spending a dime just through negotiation should be one of the first things you guys all look at in regards to value add plays on apartment investing, right?
Righto,
Mary Lou. So as the sponsor on a syndication deal, how do you get paid? Is there like an acquisition fee at the time of purchase or an asset management fee? What does that look like?
So there are a number of ways that one can get compensated as a sponsor and just through participating in a syndication as different roles in the general partnership. But let's just say my company, and I don't have employees. I handle most of it and outsource to subcontractors for some things, but I would receive an acquisition fee for putting the deal together. And what people don't think about is that some of these deals, especially if you're working with a broker on an off-market deal, they can take months to put together, and sometimes close to a year or longer. It just really depends. Or it could happen overnight, but you have to be thinking about all the time that goes into the relationship building and due diligence and all this stuff.
Well, just finding the deal.
I know. It's like people right now across the United States, I follow the multifamily community very heavily, and the general consensus is that people are looking at 100 deals to find one good one right now.
Wow.
100. They're underwriting that many. They're making offers on probably 10 of those, and maybe they'll get one. So it's a lot of effort. So anyways, that's the acquisition fee. And by the way, I loved that wow from Joe. That was so great. So I hadn't heard him talk for a while. I wondered if he fell asleep.
Nope, I'm just letting the experts talk.
He's hanging out with Mickey. So then there is an asset management fee as well. And that really depends. Some people charge that, some don't. And I'll say the acquisition fee usually ranges from 1% to 3% is very standard. And when you're starting out, you don't charge 3%. You probably charge 1%, right? You need to build up your credibility.
Well, and I think on the bigger deals for all you big ballers out there going, yeah, I'm going to set up a syndication. I think the larger the project, the lower the percentage fee, right? It's kind of
sometimes yes, sometimes no. I have been in contact with people that are doing $250 million acquisitions, and they will still charge a 3% fee, but they're splitting it with a ton of people because they have huge teams. So It depends. And if you can work it into the deal to make it work. So the asset management fee is based off of usually gross revenues as well, just like a property management fee. And that ranges usually from 1% to 2.5% or 1% to 3%. And again, starting out lower when you are beginning is the right thing to do.
But the acquisition fee is based just off the purchase price of the property. Is that right?
Yes, that is correct. And then the other way, actually there's two other ways to get compensated. One of them is a disposition fee, which is 1% to 3% when you sell the property. And the biggest piece would be that you receive a big chunk of equity when you put a deal together. And so usually that ranges from 20 to 30%. It really depends on how you can work it into the deal. I always underwrite things looking at, number one, my investors are most important. If they are not getting the returns that I want them to be blown away with, it's no use putting the deal together, because I want them to be surprised and pleasantly happy about the returns they're receiving. And I'd rather underpromise and overdeliver. So there's a lot that can be said about conservative underwriting there as well. But I usually go in at about 25% equity, and that's very common for a deal.
And does that mean that you don't have to put your money in, no skin in the game other than your sweat equity? Or do you actually have to drop cash?
Well, for that portion of the equity, that is no cash exchanged for that. That's just for my company doing the work. However, it's usually looked upon better if one invests into the limited partnership as well. So my husband and I have invested into all the apartments that we've done. And so that wouldn't be considered part of the general partnership. It's that Tamar and Bruce would be then part of the limited partnership in addition with whatever money that we put into that. You know,
I have access to funds through, I work for at this time right now, I work for a Chinese brokerage firm, and those guys, you know, obviously lots of investors interested in coming over here, but they are willing to be equity partners and JVs and all kinds of stuff, but they definitely require an 20% skin in the game by we'll call it the sponsor in this case, you know?
I think it's rare for somebody to put 20% skin in the game, especially the larger the project is. But, and I also think that usually I would put in the same minimum as everybody else that I'd be requiring from my investors. And the longer track record you have, the more you can probably fudge with that a little bit. Right. Like if I've been doing this for 20 years and I don't put money into a deal, it's not, people are going to be like, it's okay. She probably has her money tied up in a bunch of other stuff. You know what I'm saying?
Yeah.
Yeah.
So for all you smart cookies and driven folks out there, I mean, like I said, the buy and hold, the whole passive investing thing is such a hot topic right now. It is a very good time to, I mean, I think you probably have to have obviously a certain skill set, but I think you also have to have a certain personality to be a syndicator. You know, I think, you know, for me, I think over the course of my career, everybody thought that's what I was going to do. You know, they just were like, you know, because I come out of this world, I've had great successes in the apartment investing world as I was coming up in the real estate scene. But I'll tell you what, I do not have the patience or, to deal with it, I guess I'd say.
And there's also,
so I'll just be your partner then, Tamar Mar.
Tamar Mar.
Yeah, because I just don't have the patience. Although wait a minute, why is Joe sending me all these side texts like, be quiet, I'll do, no, I'll do it. Yeah. So Joe does. The good thing for us is that my partner Joe is dialed like that. I'm too scattered for the patience it would take to organize all that.
And the other thing there is that this takes left brain, right brain as well. So there's a very analytic side that goes along with analyzing deals, being diligent, and going through all the files once you get something under contract, dealing with all the contractors. There's some very more left-brained analytic type stuff that happens. But then if you're looking at the investor relations and the capital raising side of piece, that is like, okay, I have to network like crazy. I need to talk with people. I need to be having, anywhere from 3 to 10 meetings a week with potential investors and updating people on what's happening. And, your personality matters and your communication matters immensely. Yes. So you have to have a nice combination of those things. And luckily, I feel like I have that personality that I like all those things, but a lot of people partner on this too. So you might find a really analytical person with a more outgoing person. So one does more of the capital raising and investor relations, and somebody does, the underwriting and the due diligence and those sort of pieces, or the day-to-day management of the asset.
Do you guys think you'll ever take on a partner as you grow here? Are you open to that, or you guys want to stay lean and mean?
Well, I think it all depends. I'm always looking for opportunities, and there's something in me that since I was basically came out of the womb, I love kicking ass by myself. I just I was never in team sports. I'm always one of those individual sports people, but in this business, you have to have a team, and how you define that is very loose. So my team right now includes my attorneys and my brokers and my investors and my property managers and everything else, But more recently in my business, I realized that if I want it to blow up like I want it to, then I started looking at, okay, what are the areas that I really want to be focusing my time on? And what do I want to outsource? And so 2 of those things that you can outsource to really help grow your business are usually people that help capital raise, and they can get a chunk of the equity by capital raising for you. Yep. And then acquisitions, that you're having an acquisitions team. And then you have somebody in the middle that's kind of overseeing all of that. So that's what I'm doing right now, is looking for strategic partnerships that will help me. And I've been successful so far, but I'll have to say, I was pretty pumped, you guys.
We might fit in that role for you a little bit.
I know.
Investors Club. But I will say one thing is, I come out of the same kick-ass way of life, just driven to go, whether I'm by myself or in a room. I mean, I just go for it, just like you. But you know what happened to me? Is that I crossed paths with Joe Bauer.
Oh,
I think what happens is when you find the right person, it will the light will turn on for you, and you will be like, I can't let this person go. I love you, man.
I love you, man.
I love you, man.
Can I tell you something super exciting, which my jaw dropped at the other night related to my business?
Yes, tell us.
Okay, so I just got a deal under contract, a 26-unit deal for down in Lakewood, which is south of Tacoma, and I'm probably going to build 8 additional units on it. That's not the amazing part. The amazing part is I sent out an email to my investor base with preliminary information, like, this is what we're thinking, and I raised $1 million in less than 12 hours.
Nice.
Whoa, nice.
I couldn't believe it. I was like, holy junk. That was amazing. Wow. I felt so pumped because when you I love those sort of things in any business that you're in. But when you're really fired up about real estate and you find partners that are excited with you, it's like, wow.
Well, it gives you the confidence to go for it on the deals. You don't have to worry about, raising the money afterwards necessarily. I know that's sleepless nights right there. Probably people start out that way, having to raise the money. I mean, that's the whole goal, right? Is that you have investors waiting in the wings,
Yep.
For you to, what's the next one? And here at the end of this podcast, everybody, if you're interested in investing with Tamar, which we think that you guys might want to check out and get a part of, at least be notified of. We'll give you the hookup on how to do that. But let me ask you, let's keep going here on you. How do you structure then your syndications for the limited partners? Is it straight splits? Is it a waterfall? Tell everybody what waterfall means and whether you do straights or waterfall.
Waterfalls hurt my brain, so I don't do them. Waterfall, you know what the real answer is? I don't even know exactly what happens in a waterfall. I know that usually there's a preferred return. So first of all, I do a straight equity split. So my limited partners get, let's just say 75%, I would get 25%. Whatever we start doing cash flow distributions, profit sharing, then we just split it like that. So if somebody owns 10%, they get 10% of the profits. The other way to set it up is that you can have a preferred return, and 8% is really common. So especially a lot of the larger syndications. So investors would first receive that preferred return, and then any additional profits are split according to whatever waterfall stuff goes on behind there. And that can be like, if you reach this threshold of profits, we receive this much, they receive this much. But if we reach this threshold of profits, then it changes. And usually the sponsor gets more of the upside, the more the projections get blown out of the water in a good way, the more that the property is performing well, the sponsor usually would get a larger chunk of those additional profits in a waterfall scenario. But that's not the best way to describe it.
Right. Or, you get a preferred return and, after it's refinanced and totally stabilized, then that preferred return changes or something like that.
Yeah.
There's all kinds of ways. That's a whole nother topic. But so what waterfall means, guys, is that it's not just a straight split. I guess we're trying to define what it is, the definition of it. And it's more of
look in the contracts look in the offering memorandum usually of, okay, what does this really mean?
Right. You got to look a little harder. You got to understand the pros and cons on that particular deal on, if it's better for you to do that or not. But I guess as the sponsor, you're the one deciding that from the beginning. But you do straight split, so we'll leave it at that for those of you who might be interested in talking to Tamar Mar later.
Tamar Mar.
Yeah. Let's see. So is it, maybe you get your feeling on this. I've always been involved in, larger deals, anywhere 150 to even 500 unit apartment deals has been deals that I've been in before, on this, I'll call them the syndication type deals. But is it fair to say, on the value add projects that, investors might not see any cash flow for the first while the property is being repositioned because you're spending, is that an accurate statement, or is it, again, just depends? Each situation is different. I'm used to, not getting actually any cash flow until the refinance is over. Then we get the majority of our money back on refinance and have our, splits on monthly cash flow after that. But those are big projects with, $1 million to $3 million rehabs and things like that.
Yeah, totally dependent on the deal. But I think it is fair to say that if it is a value add deal where rehabs are taking place, if there's a preferred return in place, I've participated in other syndications where I get the preferred return from month one. In my deals, I actually write it into my operating agreement that there are no cash flow distributions for the first 6 months at least, because I like to make sure, you can have a plan, but then you can go into something and the plan unfolds a different way. So you don't want to set your investors up to be expecting returns immediately on something, especially if it is a rehab sort of play. So as an example, an apartment building that I bought about a year ago, we went in, it was 15 units in Spokane. We projected that 5 of the units would vacate as soon as we raised the rents, about $250 a door. And 5 did, and we were going to rehab whichever ones moved out. So those 5 moved out the first month. The next month, 2 more moved out. And then next month, 3 more moved out. So it was a crazier scenario and that we were thinking, and we could have turned around and re-rented those units right away since we were rehabbing some of the other ones concurrently. But we just decided, since we raised the CapEx at that point and the communication was clear with investors, that we would go ahead and rehab all 10 of those units, because then we could raise the rents even further and improve the value of the property by improving the net operating income. Right. So in that scenario, it's a year before people are receiving returns, because we pumped everything back into the building, but we took that building from $825,000 to $1.25 million in value in 6 months because of what we did.
Have you ever tried offering the existing tenants a remodeled unit that, yes, they're going to need to move out of their unit, but they have first crack at renting a remodeled unit? We've had some success at that, where, you just move them, you get access to their unit by giving them, maybe, some sort of rent concession on the first month, and move them into a new unit as long as they qualify, I've also had success in the past of just raising the rent and not having to, up to our projected however many, hundreds of dollars a month increase or whatever we're talking about, and they don't move out. And that's crazy. That's a win right there, right? I mean,
that is a win. Yeah. I haven't done that yet, but that's in my back pocket for sure.
Yeah. Yes. Good stuff. It's fun. If you guys like crossword puzzles, doing a value add apartment building project, if you're somebody, you're like, maybe I should if you like crossword puzzles, you will like value add apartment investing.
I've never heard that analogy before. This is amazing.
Yeah, there you go. Awesome. So let me see what else I got here for you, because we are talking long, but we're talking good stuff here today. So how does the debt work then? We already talked about on a syndication deal that, whoever is owning 19.99% or more is going to have to sign on the loan. So, but the sponsor, as a sponsor, if you're thinking, hey, I might want to get into syndication, you got to be ready to sign on the loan, right?
Yes, it's true. Right. Yep. I can dig into that a little bit if you want.
Do that. Let's dig.
Yeah. So that would be a great thing for you to talk to a commercial lender about if you haven't done this before. I know lots of great ones if you want to reach out to me. And it's a total different ballgame in commercial lending than it is in residential lending. And it's actually a lot easier to get a loan because it's asset-based lending, but they also look at the sponsor and especially the first couple of deals. So if you have no experience whatsoever, you might need to bring on what they call a key principal, somebody who has had experience investing in commercial or multifamily properties before. But in addition to that, they're looking at a couple of other things. So they're looking at your experience as an investor, and not any investor, a multifamily investor. That's really key. They're looking at if you're doing a big value add play, they want to know, have you done anything like that before? Because the bank is taking a risk on, giving you this loan. They want to look at your net worth and liquidity requirements as well. So usually speaking, it depends on the lending institution, but you need to have your net worth and the balance of the loan. So let's say I get a $1 million loan, I need to have a net worth of $1 million or more. If I get a $5 million loan, I need to have a net worth of $5 million or more. And then you have liquidity requirements as well. And that just means you need to have some cash available that usually covers 9 months or so of your principal and interest payments, or a combination of that and operating expenses that the bank determines. Some banks require it and some don't, and some have different amounts that they require. So if you don't meet those requirements, because that can sound a little bit crazy too for a lot of people wanting to get into that, you can bring on a partner who brings their balance sheet to the table, so to speak. Yeah. So and they usually call that a key principal, and that key principal would receive part of the equity share for just saying, hey, you can use my balance sheet. They might not even be putting anything into the deal themselves. They're just helping to sign on the loan so you can meet the bank requirements is all.
Right. Can your stock portfolio count as your liquidity?
I've heard that your stock portfolio can, but your retirement portfolio cannot, but it depends on the bank. So some banks will say we'll count up to 40% of your retirement portfolio because of all the fees that are associated. And stocks are, you can sell those at any time. Usually they're looking for cash reserves, but they'll take a combination of several different things. It depends.
Right. So this is one layer of debt qualifications, such as your net worth, like you said, qualifying in that way. But also the loan amount is going to be determined not only off the individual's borrowing capacity, but also off of what debt service coverage ratios and stuff like that, right?
Yep, debt service coverage ratios. So most banks right now are looking for a DSCR of 1.25. And then they're valuing it, so the loan to value is usually 75%, but it depends on the area. So if you buy in a more rural area, you might have to pay 30% down. But if you're getting a large balance, Fannie Mae or Freddie Mac loan, you could do 80% loan to value, depending on the area that it's in. But those are good questions to ask a lender as well. What is your loan to value that you provide? What DSCR do you require? And
the loan amount is going to be the lesser of 75% loan to value or the 1.25 debt service coverage ratio. And what that means, guys, is that your net operating income on the property needs to be 25%? Is that how we say it?
Yeah, 125% of
higher than your loan payment.
Yep.
Right. So if you take your annual mortgage payment times 1.25, that's what your NOI needs to be to qualify for that loan amount, right? So you can calculate and back into that all that way. So there's a few benchmarks. Those are 3, right? The loan to value, the debt service coverage ratio, and your borrowing capacity are the 3 things that you need to focus on. And what I'm telling you guys, whether you're investing in single family or apartments or whatever, is my new thought process. We like to, somehow we've turned into, never in my life did I think that I would be helping to educate anybody about anything, but it's somehow fallen in our lap that we're doing that. But I think a big topic going forward is I'm going to be focusing big time on understanding debt. I think that people go out and they start investing or wanting to be investors, and they go at it let me figure out what the deal is. I think it's better to understand what you can borrow and then back into finding a deal of what you can qualify for. And narrowing your niche. And then on top of that, going back and talking about how important your borrowing capacity is and what a key principle and things like that is that, and your borrowing capacity relating back to your experience, just like we talk about in flipping and rehabbing, guys, partner up. Don't just start doing all this stuff on your own. Tamar has a lot of experience and has been in a lot of deals and is not, fresh off the boat here. You guys should always focus on partnering up with somebody more experienced from you, not only to learn, but also to get credit on your portfolio for deals done.
Yeah. And also if partnering up can also be investing in somebody else's syndication so I started doing that about 1.5 years ago for really, really big deals. Cause I wanted to see how are they putting the deal together? How are they underwriting? What is their marketing package like? How are they doing investor communications? What is their monthly reporting? How promptly are they? Blah, 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 blah. And so I wanted to do that so I could learn from them by being passive, but also seeing what sort of communications they have. But you can also use that in your credibility kit. So you can say, well, I've invested in a 500 unit complex in DFW, Texas before.
There you go.
Yeah.
That right there, another key component of today's podcast. Mm-hmm. So understanding the 20% threshold thing, and also understanding how important it is to get some deals, in your resume.
Yeah.
From now. So you better start thinking about that now. so you can set yourself up to be a borrower yourself in the future. Totally great stuff related to that. So you're saying that if somebody is a limited partner in a syndication deal, that would qualify for them when we're talking about borrower criteria and qualification? Do you think that?
I don't know if that really qualifies you from a borrower standpoint, but I think it adds to your credibility a little bit of understanding what this is all about, and it gives you more confidence to do it on your own. So from a confidence standpoint and from understanding what needs to be done, I think that really helps. I
would ask somebody. I'm curious to know the answer to that question. Maybe you can ask one of your commercial contacts for us and report back to that.
I will. I do know though that even if you own just a sliver of the general partnership, that counts. So let's say you bring a deal to somebody, or you raise capital for somebody, or you do something else in the general partnership, and let's say they give you like 5% of their 25%. That's what matters. You're on the general partnership, and that qualifies you more. So even if you have a tiny sliver in that GP, that banks will look favorably on.
Right. Nice. Good stuff, guys. Exciting. All right. Well, let's see. Well, let's that's all good stuff. Let's ask something more fun here as we wrap it up.
Fun.
So yeah, let's
get to
some more fun stuff, and then we'll wrap it up. So what else do you like investing in besides real estate and businesses? Right, you're an interesting person. I know you just bought a beach or something.
Did.
What else you got? What else you got? Joe bought a van and retrofitted and tore it all up, and is now living in it. You bought a beach.
I did.
I don't know what I'm doing. I'm a little behind.
Oh man. Well, I mean, my favorite thing to invest in is real estate. And we've done, besides single family and multifamily, we've bought land. So we have a lot in Hawaii that we've purchased 5.5 years ago that we're going to build our second dream house on in about probably 2 to 3 years. And then
as long as the lava doesn't roll that direction.
No, it's not. It's way far away from that. We're all good there. But more recently, we purchased a 4-acre parcel of land on an island about an hour south of Seattle, and it's waterfront. And we're building our dream house there. We just met with our builder yesterday for the first time, and just some cool stuff surrounding that. I like investing time in my family, most importantly. My family is my favorite, and outdoors are my favorite. So anytime I can combine those two things. And so since we bought this 4-acre parcel, we have 386 feet of waterfront. So I own a beach now.
Now you're going to
look straight out at Mount Rainier. It's like the best view in the history of the world. It's amazing.
Wow. I can't wait for the invite.
We are having a barbecue there for all of our Seattle investors.
A barbecue.
Yeah, we don't throw barbecues. We throw barbecues all.
Nice. What's your outdoor poison? Are you a hiker? Or are you like a skydiver, or what are you?
I've done skydiving before. I mostly love the mountains and the ocean. So I do hiking, backpacking, skiing. This summer for my 40th birthday, I'm going to spend 12 days out in the wilderness in Mount Rainier. I love boogie boarding so much. I like surfing. I don't like snorkeling so much, but I really, really, really love boogie boarding, and I'm kind of good at it.
Wow. Oh my God.
I'll take you on.
You might have to have a boogie board off or something.
Yeah. And when we're in Hawaii, we go every year for 2 weeks at Thanksgiving, and my husband is a 6'2" Chinese American guy, and he turns black. He turns the color of night from sitting under a palm tree in the shade. It's crazy. So, and our kids look like look like little Hawaiian kids. So and I tan really well. So I'll be out boogie boarding in the ocean. There's all these local kids, and they'll start calling me Auntie. That's a good one you caught there.
Nice.
Cracks me up.
It's all good. Well, I am inspired to maybe invest with you. I'm also inspired. I'm back to the pulled pork sandwich, Joe. Sorry.
Oh, no.
Yeah, I'm inspired to go get a pulled pork sandwich because I'm starving.
Oh,
I'm starving at this
point. Take care of that.
Yeah, I gotta take care of that. Yeah. I'm not the one driving around with a gym on the back of my car like Joe.
My gosh.
Yeah, but I am strong enough to do some arm lifts with a pulled pork sandwich.
Okay.
Nice.
Yes.
Nice.
Must be an inside joke that I did not hear before.
No, I don't know why, but we end these podcasts about 12:30, and for some reason that I'm always starving by the end of them,
Yeah.
So I'm starting to lose track of
what are you going to get for lunch today? Are you really getting a pulled pork sandwich?
I just might be. I'll let you know. I'll put it in the comments of the podcast. How about that?
You need to let us all know. We're going to be curious now. My mouth is watering.
I know.
Mm-hmm. Now I want one.
What are you eating for lunch today, Joe?
Oh, you don't want to know. We still meal prep, even though we're on the road. So we have Tupperware full of, let's see, it's a salad with
chicken and broccoli.
I think it's ground turkey and some vegetables with some sort of dressing on it. So
how do you do that on the road? Do you have a big freezer?
We have a pretty good size. It's like half the size of a normal refrigerator. And then we have a stovetop and a sink. So, and get this. When we were doing our battery, we had them make sure that we could use an instant pot. So we could manage an instant pot. So we cook a lot of our stuff in an instant pot and then throw it all in the fridge for the week.
Whoa.
Yeah.
Always planning ahead, that Joe Bauer.
If y'all don't have an instant pot, you should get one. They're great.
Okay, I need to get one then.
My God.
It's like
maybe I'm going to go get an instant pot instead of a pulled pork sandwich. That sounds...
You're going to be way too starving by then. That'd be like 4 o'clock before you ate lunch. You get hangry.
Yeah. Although instant pots cook really fast. That's the cool thing about them.
Well, hopefully, if they're called an instant pot.
Heck yeah. I think we did our last meal prep in 10 minutes for the cooking of the meat. Yeah. So you could do like a whole week of pulled pork, Julie. That would be cool.
Oh my God. I could.
Might change your life.
That might change my life. Well, let's Tamar Mar, tell us how, if people are interested in learning more about what you're doing, your podcast, or want to get on maybe and learn about some of the investment offerings, however that works, however they can find out about that from you, what can they do? Tell us where they can go.
Yeah. They can certainly visit my website at marotagroup.com, which is MAROTA group. And then I also have my podcast, investingforlifepodcast.com. And I have a contact form on my website. I'm required to build relationships with people before they invest with me, which is a good thing because I really like people and I love talking. So if you want to talk more about it.
How hard is that?
I know.
To get people to visit with. Jeez.
Yeah. So hit me up and I'd love to talk to you more.
Good
awesome.
Stuff. I think that's wrapping it up for today. Awesome, Tamar. Thanks for coming on.
This has been the best podcast interview in the history of time. Thank you so much, Julie and Joe.
We loved having you. And if anybody wants to check out the show notes, they can do so at seattleinvestorsclub.com/34. And did I mention that we love 5-star reviews on iTunes? So if you guys would like to give us one, you can go to seattleinvestorsclub.com/iTunes.
I'll be giving you one for sure.
High five.
High five, everybody.
Bye.
All right, Tamar. Cool, can't wait to hang out, and we'll see you soon.
Sounds good. Thanks, guys.
See ya.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.